So the biggest thing I learned from Marty, and I'll tell you a story that you might find. The biggest thing I learned from Marty, which was an absolute light bulb for me when I really began looking and reading and coming into my own in terms of what kind of investor I was drawn to being, is Marty's basic insight that you value a business completely independent of the market. You value a business, you determine what discount you want to own that business to account for the risk of owning it, and then you go to the public markets to see if that price is available. So if you think about it, you're not talking about the markets. You know, there's just so many clowns on TV talking about what they think the Dow is going to do next week, whether it's backfilling, just a bunch of noise. And so in a stroke, Marty eliminates all of that, which is 90% of what you see on cable television, right? What the Fed is going to do, what's this going to do? It's just nonsense to someone who thinks about companies and thinks about their valuations as basically value being derived from one of two components. What can you sell it for, or parts of it, and what can be the cash flow that you can generate from it, right? So we always ask ourselves, would we take this business private in a heartbeat? So if we could take it private in a heartbeat, and that represented an amount of capital that was similar to the amount of capital we're thinking of deploying in the public security, that's our North Star. And so for me, Marty just really kind of crystallized that's market stuff. It's not what we do. Other people are welcome to do it. Additionally, you can't obviously talk about Marty without talking about balance sheet first. So balance sheet strength, and you can live with volatility, but you don't want to live with kind of binary risk from leverage balance sheets. Quick story I'll mention, in probably 95, I began, kind of writing some research for our clients. And I met someone at the time who worked alongside Marty. He said, you should send some of this to Marty. I said, what the hell is he going to do with my ideas, right? So this is way before the internet days. And I faxed a 3-page idea. And the next morning, my assistant calls and said there's a Marty Whitman on the phone. Now this is 1995. I'm, I guess, 35 years old. And a guy I adore and admire and look up to is on my phone, wanting to talk to me. So he said, hey, this is Marty Whitman. I've got your idea here. So we'll buy 1 million shares. We'll pay you 2.5 cents a share. So fortunately, I did not say, and it crossed my mind for a second, how about 3 cents? Because I think he would have hung up immediately. I said, well, boy, that's wonderful. Thank you, Mr. Whitman. What a great honor it is to present an idea that you want to invest in. And he said, it's a great idea, but like most great ideas, it's a pretty simple one. And it was, and it worked out. And we've had a wonderful relationship ever since. I would mention Walter Schloss, who really, I think, did something unique in his focus on assets and less on the current income statement. And he basically said, income moves around, earnings move around, asset values don't as much. So I think a lot of people coming out of business school, I think a lot of the industry is really focused on the income statement. And I think that one of the things you have to do as an investor is somehow differentiate your thinking in some way. Otherwise, you're just competing against too many like-minded people. So even though there may be more maybe there might be more momentum or growth investors. Even if you're a value investor, if you're first focused on income flows, I just think you have a lot more competition. People are willing to throw out the baby with the bathwater when income states look poor. What we try to do is look through current underperforming, under-earning businesses, try to derive at what's hard, what's sturdy, and we want situations where there's multiple assets there to provide downside protection. We are rarely involved in leveraged securities, so we're talking about businesses that don't have kind of binary risks. And I think Schloss, if you read, he is a tremendously humble guy, had deeply experienced loss, had a real sense of life can change quickly on a dime. He fought in World War II and really discussed how deeply that affected him. He understood how precarious life was, how precarious markets are, how things can change. Those are the kind of thinkers that, I've always been drawn to, and I think, again, because of, what I know personally with loss. So the way that derives to an investment rationale, among other things, is you can, the balance sheet makes perfect sense, right? And also, I'm much more bird in the hand versus two in the bush.